Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever thought about what it would be like to have a massive fortune? Sounds like the ultimate dream, right? But what if I told you that achieving that dream, getting that huge pile of money, can actually become a family's biggest vulnerability? Turns out, building a dynasty is one thing, but keeping it, that's a whole other ballgame. So, our guide for this little explainer is the book Wealth by Stuart E. Lucas. Now, you got to understand, Lucas isn't just some theorist writing from an ivory tower. He is the fourth-generation heir to a huge American fortune, and he learned all the lessons we're about to cover the hard way, with his own family's real money on the line. You've probably heard this old joke before, right? It always gets a little chuckle, but hiding inside that joke is a very, very serious truth. Huge fortunes can, and often do, disappear with shocking speed. And for one very famous American family, this wasn't a joke at all. It was a real danger that was about to unravel a billion-dollar legacy. And that drama brings us to the Stuart family, the founders of the Carnation Company. Yeah, that Carnation. Their story is the perfect case study in how achieving the American dream can actually turn into a nightmare if you don't have the right strategy to protect what you've built. The company's journey was just incredible. I mean, it ticked off in 1899 with only $25,000 and an idea for evaporated milk. And over the next 86 years, it grew into this global food giant, all leading up to a massive sale to Nestlé back in 1985. Let's just pause on that number for a second. $3 billion. At the time, that was the highest price anyone had ever paid for a food company. This wasn't just a successful business deal. This was a monumental, historic event. For the Stuart family, who controlled a huge piece of the company, this meant their entire world changed overnight. What was once tied up in company stock was now almost $1 billion of cold, hard cash. Liquid. I mean, this was it, the ultimate financial victory. Or was it? Because while the family was celebrating this incredible windfall, a critical flaw in their financial strategy was already quietly at work, a flaw that was threatening to tear down everything their great-grandfather had built from the ground up. And here it is. This is what was happening. Years later, Stuart Lucas dug into the family's numbers, and what he found was just shocking. I mean, look at this chart. During a massive bull run, the U.S. stock market was roaring ahead, up 133%. And the family's portfolio, managed by top-tier professionals, it grew by a measly 31%. Now, this wasn't just about missing out on bigger profits. No, it was way more serious than that. When you factor in taxes, all the advisor fees they were paying, and just plain old inflation, their billion-dollar fortune was basically stagnant. In real terms, it was actually shrinking. The financial engine had completely stalled out. You know, this is that classic curse of family wealth, and the Lucas family was staring it right in the face. This old saying captures that tendency for a family to build a fortune in one generation, only for it to be completely gone by the third. They were on a fast track to becoming just another statistic. So how could this possibly happen, right? We're talking about a billion-dollar portfolio managed by the best in the business. How could it fail so badly? Well, the answer isn't in the investments. It's in the deeply flawed, yet totally standard approach to wealth management that most people are taught to follow. This right here is the standard playbook. It looks totally logical, and it's the process that pretty much every financial firm in the world uses. But as the Stuart family found out the hard way, this seemingly sensible approach has a hidden, critical flaw. And here's the flaw. This whole process puts you, the owner of the wealth, in the passenger seat. A lot of the time, it's designed more for the convenience of the advisory firm than it is for your unique goals. It makes you passive, it's fragmented, and it's missing the most important ingredient of all, you. So, facing this crisis, Stuart Lucas basically created a completely new way of thinking about wealth. He built a framework that's designed to put the owner back in control, to make sure the money is serving their life, not the other way around. This slide just lays out the shift perfectly. It's all about moving from being passive to being proactive, from being driven by your advisors to being driven by your own goals. And you're moving from a fragmented, product-focused approach to a holistic one that's built around your personal values. This is what he calls strategic wealth management. It's a philosophy that says you are the wealth strategist. You're the CEO of your own fortune. Your job isn't to pick stocks. It's to set the grand vision and the core strategy that all of your advisors have to follow. So, where does this new strategy even begin? It's not with spreadsheets or market forecasts. It actually starts with a really simple but profound question about who you are and what you really want. The core idea here is so simple. Values have to come before tactics. Before you even talk about asset allocation, you need to talk about your life goals. What is the purpose of this wealth? Is it for security, philanthropy, starting new businesses, building a family legacy? The answer to that question changes absolutely everything. Lucas uses this fantastic question to make it really concrete. Eating well implies you're going for a higher risk, higher growth strategy. You want to maximize that fortune. Sleeping well, on the other hand, implies a lower risk, more conservative strategy that's focused on preservation and peace of mind. Now, there is no right answer, but you must know your answer before you invest a single dollar. This whole process of taking control, of defining your values, it all leads to the book's most powerful insight. It's a fundamental change in the way you even view wealth itself. This was the family's huge epiphany, their aha moment. They realized they weren't just the owners of a pile of money, free to do whatever they wanted with it. No, they were stewards, like temporary caretakers of a resource that had been passed down to them. And that's really the essence of stewardship. It reframes wealth from being a simple possession into a tool and a responsibility. A tool to not only provide for your own family, but to build something lasting that can benefit future generations, and maybe even the wider community. And that's the question this whole story really leaves us with. It forces all of us to look beyond our bank balance and ask, what are our resources truly for? Because when you see your wealth not as an end in itself, but as a tool for a greater purpose, well, that's when you've moved beyond the bottom line and into the realm of strategic wealth.
All right, today we're going to talk about managing your wealth. But forget the dry, boring stuff. Think of it like a game that has its own rules, its own language, and its own strategies. And by the end of this, you're going to know how to play and how to win. So let's jump right in.
You ever have a moment like this, where you're in a game, but you have no idea what the rules are, what the words mean, or what you're even supposed to do? This quote, it's actually from a father who is getting crushed in a game of Pokemon by his 8-year-old son. And it just perfectly captures that feeling of being completely and totally outmatched.
And honestly, isn't that exactly how managing your own money can feel sometimes? Like you're in a completely alien territory, trying to play a game with all these complicated rules and a vocabulary you just don't get. If that sounds familiar, trust me, you are definitely not alone.
And this gets us to the real heart of the matter. You know, taking control of your wealth isn't really about the sheer amount of money you have. It's all about the process. Real power, real control, that comes from how well you manage it, not how much you're managing.
So let's stick with this game idea for a minute. The whole financial world can feel like a game where you're the only one who didn't get a rule book. The language is designed to be intimidating, the terms are confusing, and you're just trying to keep up, really hoping you're making the right move.
And this right here, this really shows you the imbalance of power, doesn't it? On one side, there's you, just trying to figure out the basics. On the other, you've got your advisor, the expert who knows all the rules, all the fine print, and exactly how to use them. It's a setup that can make anyone feel pretty powerless.
And figuring out how to play this game is more important now than ever. Why? Because over the next 50 years, we're about to see the single greatest transfer of wealth in U.S. history. We're talking at least $25 trillion being passed down to heirs. And a lot of people are just not going to be ready for that responsibility.
Now, if you feel like you're lost in this system, look, it's not entirely your fault. The wealth management industry itself is often set up in a way that can actually work against your best interests. Let's dig into why that is.
So it really boils down to three main problems. First, your goals and your advisor's goals can be totally different. They're often tied to making money for their firm. Second, advisors almost never get the full picture of your family dynamics, the stuff that really drives your decisions. And third, most experts work in their own little bubble. The tax lawyer isn't talking to the investment guy, and you're the one left trying to piece it all together.
And this quote just hits the nail on the head.
It's so hard to tell if an advisor's actually doing a good job. So you're basically forced to just trust them. It's a huge reason why so many people are unhappy with their financial advisors.
So what do most people do? Well, that anxiety kicks in and there's this big rush to just hire someone. This usually leads to what we call the classic approach. And spoiler alert, it's flawed because it's built around the advisor's needs, not yours. This is what that classic approach usually looks like. It's this rigid 5-step assembly line. You pick an advisor, they set a policy, they allocate your money, they pick some managers, and then you check in once in a while. See what's happening here? You're basically a passenger. The advisor is in the driver's seat, and often they're in a hurry to get your money invested so they can start making a commission.
The problem isn't that every single step here is wrong. It's that the whole approach is just incomplete. It's exactly like having a powerful gun, but with no way to aim it properly. You're firing away for sure, but you're probably not going to hit the target you actually care about. There's got to be a better way, right?
Well, there is. It's a whole new way of thinking called the Strategic Wealth Management Framework. And this isn't some tiny little tweak to the old system. Oh, no. It's a complete shift in philosophy that puts you, and I mean you, firmly back in the driver's seat.
I mean, just look at the difference here. Instead of that straight, rigid line driven by an advisor, this is a holistic approach with you right there at the very center. Everything, and I mean everything, starts with your values, your resources, and how you communicate. Everything else is built around that core.
So, what does this actually do for you? Well, it means you start making decisions based on what you really want, not just some sales pitch. It means you hire advisors whose skills actually fit your goals, not the other way around. You can align your investments with who you are and what you care about. And in the end, you can actually project your values out into the world and build a legacy that means something to you. Now, to make this framework really sing, you need to step into a new role. You're not a passive client anymore. You're an active leader. You are the CEO of your own wealth. And that role is the wealth strategist. This is the person who is ultimately responsible for creating and carrying out the family's entire wealth strategy. You set the vision. You oversee the team. You're the one in charge. Okay, I know what you might be thinking. CEO? I'm not an expert in stocks or tax law. And that's the great part. You don't have to be. That's what you hire the experts for. Your job is something different.
Your job is about leadership. It requires patience, good communication, and the discipline to actually stick with the plan. It's about knowing yourself, understanding the basics of the industry, and then leading your team of experts effectively. And these are all skills you can absolutely learn.
And that's the bottom line. This whole powerful framework, it all comes down to one thing: your leadership. You have to take personal responsibility for your wealth. You have to be the one who decides to take control. So, we'll leave you with this question. Who is the wealth strategist for your family? And if the answer isn't you, who is it? And if you realize there isn't one, what's the very first step you can take today to claim that role? Because the person in charge of your wealth, well, it should be you.
You ever wonder how some families just keep their wealth for generations, while for so many others, it just seems to vanish? It's not luck, and it's definitely not some secret formula. It's all about strategy. So let's dive into the 8 core principles that can help pretty much anyone build and protect their wealth for the long haul. You know, the physicist Richard Feynman absolutely nailed it with this quote. Passing on wisdom, especially when it comes to money, is this incredibly tricky balancing act, right? How do you share what you've learned, what actually works, without kind of stifling the next generation? That is the core challenge, really, of creating a legacy that actually lasts. I'm sure you've heard the saying, shirt sleeves to shirt sleeves in 3 generations. You know, the first generation builds it, the second enjoys it, and the third, well, the third loses it all. But why? Why is that pattern so incredibly common? Is it just inevitable? Well, the source material for this explainer says no, not at all, if you understand the powerful force that's working against you. And here it is. This is that force. The author gives it a name, family entropy. It's a fantastic analogy. Just like in physics, where everything naturally tends to fall into disorder, a family's wealth, their values, their unity, it all has a natural tendency to drift apart over time. But here's the good news. You can fight it. You can counteract that entropy. And it all starts with taking control. So, okay, how do we actually fight this entropy? Well, we're going to start with the first 2 principles, which are all about laying a super strong foundation. It boils down to this: take charge and align interests. And let me tell you, this is not something you can just hand off to someone else and forget about. All right, principle number 1, you have to take charge, and you got to do it early. The key idea here is that someone has to be the leader, the quarterback of the whole operation. The author calls this person the wealth strategist. This is the person who's responsible for really articulating the family's core values and setting those big long-term goals. See, if you just wait around for advisors to tell you what to do, you're not going to get a strategy. You're going to get a pile of disconnected financial products. You have to be the one driving the bus. Next up, principle 2 is all about aligning interests. Once you have that leader in place, the next job is to get everybody on the same page. You got to get everyone rowing in the same direction. What this means is making sure the interests of all the family members and even your professional advisors are all pointed towards those common goals you just set. When everyone is rowing together, believe me, the family has way more power and focus than any single person could ever have on their own. Okay, so we've got leadership, we've got alignment. Now it's time to build the systems, the rules of the road that are going to guide all your decisions. This next section covers the principles for creating that structure. Honestly, you can think of it as building your family's wealth management operating system. And that brings us to principle number 3. This one is an absolute game changer because it tackles the really difficult emotional stuff that happens when you mix family and business. So check this out. Create a culture of accountability. The trick here is to frame wealth management as a business activity, not just a messy family dynamic. When you do that, you can bring in objective performance metrics, and that makes those super awkward conversations so much easier. It completely changes the dynamic from, hey, I'm disappointed in you, to something much more manageable. Like, look, I love you, but you are just not performing against these goals that we all agreed on. See the difference? It's huge. Okay, on to principle 5, delegate, empower, and respect. Look, you can't do everything yourself. It's impossible. You have to delegate the day-to-day stuff to competent professionals that you really trust and empower them to act for you. But this principle also applies right inside the family. It is so important to respect the independence of other family members. That means supporting their passions and even giving them the room to fail on their own terms. That's how you build resilience and self-confidence, 2 things that are absolutely essential for any future leaders. Now, here's a question. It's pretty easy to assume that when you've got a lot of wealth, you need these incredibly complex, super sophisticated strategies, right? I mean, advisors will certainly pitch you plenty of them, but is that really the best way to go? Nope. Principle 7 tells us to always err on the side of simplicity. A simple, low-cost strategy often gives you 90% of the benefits of a super complex one, but with way less risk, a lot more flexibility, and just fewer things that can go spectacularly wrong. So before you jump into some complicated scheme, you have to ask yourself, is this really, truly better than the simple, straightforward alternative? All right, so far, we've been playing defense. Now, let's switch to offense. This next set of principles isn't just about protecting the wealth you have. It's about actively using your family's unique position to go out and create more. This leads us right into principle 4, and it's a really powerful and, let's be honest, often misunderstood concept: nepotistic advantage. Now, this isn't about giving your unqualified cousin a cushy job. Not at all. It's about strategically using the combined power of the family's financial assets, their skills, their networks, all of it, to create opportunities that just wouldn't be there for any one person alone. And this slide just lays it out perfectly. Raw nepotism on its own? Yeah, that's a recipe for disaster. It leads to entitlement and a weak business. But, and this is the key, when you combine nepotism with a true culture of meritocracy, where privilege comes with real responsibility, it suddenly becomes this massive competitive advantage. It keeps everyone, family and non-family alike, totally sharp and motivated. Principle number 6 tackles this really fundamental tension, what the author calls the duality of capital. Just think about it for a second. How is massive wealth usually created? By focusing like a laser on one successful thing, right? But how is it usually lost? By having everything tied up in that one thing. So you need to do both. You have to diversify your assets broadly to protect what you've got, while at the same time applying that focused, intense energy to create new opportunities that can give you those outsized returns. And that brings us to the final, and you could argue the most important piece of this whole puzzle, making sure this entire system can last long after you're gone. And here we are at our final principle. Number 8, build the next generation. The ultimate goal here isn't just to transfer assets from one account to another. It's about cultivating the next generation of leaders. And that means you have to actively involve them in financial talks from a young age, teaching them the values of accountability and stewardship, not entitlement. And here is just a fantastic, tactical piece of advice on how to do that. The idea is that no one in the next generation should come into the family business without first spending at least a decade succeeding on their own outside the family bubble. Think about what that does. They bring back real-world experience, a fresh perspective, and maybe most importantly, the confidence and credibility that only comes from knowing you made it on your own merits. So let's bring it all home and look at the Wealth Strategist playbook. This really sums up the role. You're the central hub. You articulate the vision and the goals. You build the right team of advisors, you oversee the entire integrated system, and you're always on the lookout for those hidden risks, everything from overspending to, family relationships starting to fray. Which, leaves us with one last thought. After hearing all this, it's really worth asking yourself, is this role for you? Every family needs a wealth strategist. Could it be you? Or maybe, should it be you? What if I told you that the most important financial decision you'll ever make has absolutely nothing to do with money? I know, it sounds kind of weird, right? We're always told that managing wealth is all about spreadsheets and market trends and picking the right stocks. But honestly, that's all secondary. The real work, the stuff that truly matters, starts by answering some pretty deep questions about who you are, what you stand for, and the kind of life you actually want to live. And this right here, this quote from John D. Rockefeller Jr., just cuts right to the heart of it. We live in a world that's pretty obsessed with net worth, but he reminds us that real wealth, that's measured in your character. And you know what? That's the foundation we've got to build on, not just for our finances, but for our whole lives. So that idea from Rockefeller leads us straight to our first and most important step, figuring out your why. Seriously, long before you even think about asset allocation or risk profiles, you have to get totally clear on your core values. Because any successful financial strategy, any of them, isn't built on numbers. It's built on purpose. So this is the big one. This is the question. What do you really want to accomplish? Is your why all about, say, funding a breakthrough in medical research? Or maybe it's about making sure your grandkids can chase their dreams without being buried in debt. Whatever it is, the answer to this question is the real starting line for your entire financial journey. Okay, so once you start to get a handle on that why, you'll find that your wealth can fuel all sorts of life's great adventures. And these aren't just abstract ideas. They translate into real, tangible paths. So let's explore 7 of the most common ways you can put your resources to work. Just think of this as a menu of possibilities for your life. First, you could focus on maximizing your financial security and retirement, just making sure you're totally set. Or you could take that capital and channel it into new ventures, maybe building a business and creating even more wealth. Perhaps your why is all about just spending your money to experience the world, creating a lifetime of incredible memories. You might decide to create a special place, a lake house or a city apartment that becomes the heart of all your family gatherings. Or, hey, maybe you'll become a collector, curating art or classic cars, something you're just incredibly passionate about. Your purpose could be philanthropic, donating to causes that really mean something to you. And finally, you can simply give directly to the people you love and care about. Now, the key thing to remember here is that these aren't competing priorities. You don't have to choose just one. They're all ingredients. The real magic happens when you find the right balance for you, creating a unique recipe for a fulfilling life that is totally and completely your own. But look, choosing your path is only half the story. Now we've got to talk about the journey itself. And that brings us to a really simple, but honestly a profound question about your personal relationship with risk. So let me ask you point blank, when it comes to your money, would you rather eat well or sleep well? Just take a second and think about it. Your gut reaction to that question, it probably reveals a whole lot about your tolerance for financial uncertainty. So the sleep well approach, well, that's for those of us who really prioritize peace of mind. Imagine your portfolio is like a calm, steady river, just gently flowing toward your goals. On the flip side, the eat well approach is all about embracing risk for the chance of a bigger reward. Picture that portfolio more like a thrilling whitewater rafting trip, with potential for some absolutely exhilarating highs, but also some pretty heart-pounding drops along the way. But here's the thing, your financial journey is rarely a solo trip. It involves the people you love most. And that's why understanding your own comfort with risk is just the beginning. The next step is figuring out how to talk about it all with your family. Think of it this way. When everyone in the family is on the same page about money, about its purpose, its challenges, its opportunities, you're not just managing a portfolio anymore. You're building a legacy of trust and shared purpose that can make your family stronger for generations. But here's the delicate dance you have to do. You want to empower the next generation, right? Not create a sense of entitlement. So it's all about having those conversations that teach them that with great privilege comes great responsibility. A responsibility to your family's values and to the wider world. Okay, so think of your values, your risk tolerance, and your family communication style as the key ingredients. Now we're ready to actually put it all together, and it all boils down to one of two fundamental financial orientations. So as you look at these different issues, where do you see yourself? Are you focused just on your own lifetime, or are you thinking about a multi-generational legacy? Are you a sleep well person or an eat well person? Your answers are going to start painting a really clear picture of your financial DNA. If you find yourself leaning more toward that first column, you're probably what we'd call distribution-oriented. Think of your wealth as a really well-stocked pantry. Your main goal is to enjoy a lifetime of delicious meals for yourself without really worrying about leaving a full pantry behind for other people. Now, if you're leaning to the right, then you're growth-oriented. In this case, your wealth is less like a pantry and more like a magnificent orchard. Yeah, you get to enjoy the fruits of your labor, of course you do, but your primary focus is on nurturing those trees so they can keep providing for generations to come. So you see, whether you're a pantry person or an orchard person, figuring this out gives you your North Star. It's the compass that brings clarity and purpose to every single financial decision you make, from your investments all the way to your estate plan. And that brings us right back to the very beginning. So as we wrap up, I'll just leave you with this. The single most valuable investment you will ever make is the time you spend answering that one simple question: what are your values? Because in the end, that's what truly defines your wealth and your life.
You know, every financial choice you make, from what you spend on coffee to how you plan for retirement, it really all boils down to one core question. What is your money for? Today, we're going to explore the two very different paths your answer can lead you down. So let's dive right in.
Seriously, this is the foundational question you've got to answer before you even think about stocks or bonds. Is the wealth you're building meant to fund your life, to maximize your experiences and your security? Or are you building a legacy, something that's going to support future generations long after you're gone?
Your answer literally puts you at a fork in the road. One path, we call that distribution-driven. I mean, think of it like planning the most incredible multi-decade vacation of your life. The other path is growth-driven, which is way more like planting an orchard that's going to feed your family for generations. And believe me, these two mindsets, they lead to completely different financial strategies.
Okay, so let's start by walking down that first path, the distribution-driven approach. Here, the main goal, the whole point, is to use your wealth to fund your lifestyle within your own lifetime. But, even on this one path, there are a couple of different ways you can go.
So this first option is all about protecting your lifestyle from inflation. The goal is super simple. If you spend, say, $100,000 this year, you want to be able to spend the equivalent of that, maybe $103,000 next year, to buy the exact same stuff. You're basically prioritizing your current standard of living, even if that means the total value of your assets is slowly, ticking down over time.
But here's the massive trade-off, right? To avoid all that crazy market volatility, you might go for a really conservative, low-risk investment strategy. But when you're spending that much just to keep up with inflation, you face a much bigger risk: the very real danger of outliving your money. A high spending rate right out of the gate could literally wipe out your assets in as little as 15 or 20 years. Yikes.
Okay, the second option on this path is really all about stability. You decide, hey, I'm just going to spend a fixed percentage of my assets each year, maybe 4%. This gives you a super predictable income, but, and this is a big but, you have to accept that inflation will gradually eat away at your buying power. What you can buy for that money gets a little smaller each year. Still, since spending needs often go down as we get older, this can be a really practical way to go.
A lot of people, whether they plan it or just kind of fall into it, end up in this category. And the great thing about this strategy is that if you manage it carefully and you're smart about your spending rate, you're way more likely to preserve the value of your assets. And that doesn't just give you a financial cushion for unexpected stuff later in life, it also makes it possible you might actually leave something behind for others.
All right, let's completely switch gears and cross over to that second path, the growth-driven approach. Now, this is for people whose time horizon is, well, it's way beyond their own life. We're talking decades, maybe even generations. Here, the goal isn't just to spend your wealth, it's to actively preserve it and, more importantly, grow it. So, the first stop on this path is all about conserving the real value of your wealth. And to do that, you've got to fight that long-term relentless corrosion of inflation. And that, well, that requires a huge shift in strategy. You absolutely have to lower your spending and take on more investment risk just to make sure your portfolio's growth can outrun the rising cost of living over the long, long haul.
Okay, this next option takes things a step further. It's not just about beating inflation anymore. Now, it's about beating inflation and family growth. I mean, think about it for a second. If your family doubles in size over generation, your wealth has to double in real terms just to give each person the same standard of living. This is like the ultimate generational goal, and it requires a seriously aggressive growth strategy.
And finally, we've got the entrepreneur's approach. Look, this isn't about passively investing in the stock market. Not at all. This is about using a business or maybe a high-powered career as the main engine for creating wealth. You keep your spending from liquid assets super low because the real explosive growth is happening through your active work in your ownership.
So here's the crucial takeaway. All three of these growth options demand incredible discipline. I mean, spending has to be kept low. We're often talking below 3.8% of your assets. You have to be willing to stomach some serious market volatility. And it takes real skill, either your own or from advisors you trust, to manage taxes and investments effectively over all those decades.
Okay, so we've laid out all the philosophies, but what do these different choices actually look like in the real world? You know, what happens when the rubber meets the road? Let's find out.
Let's actually run a little simulation. Imagine 5 different people. They each start with exactly $1 million, and each one picks one of the different paths we've talked about. Now fast forward 20 years. The differences in where they end up, they aren't just small, they are absolutely staggering.
And wow, the results are dramatic. Just look at the bar on the far left. That's the maintain purchasing power strategy. Sure, it allowed for the most spending over those 20 years, but it absolutely decimated the principal, leaving less than half of the starting $1 million. Now, look all the way over to the far right. The keep growing it strategy, it ended up with over $4 million in assets. It quadrupled the initial investment, even after all the spending along the way.
This table just brilliantly illustrates the incredible power of compounding. Just look down that initial spending column for a second. The strategies at the bottom, the ones with the lowest initial spending, are the ones that ended up with the highest final asset values. It's amazing. By deferring that gratification and just focusing on growth, these paths created way more wealth and, ironically, gave them the ability to spend much, much more later on.
So this really brings us to a super crucial point. Behind all these strategies, there's this constant tug of war going on. You can think of every financial plan as a battle between two fundamental, totally opposing forces.
On one side of the rope, you have what our source material calls leakages. Just think of it like a slow, constant drain on your wealth. And it's not just your spending, it's also the taxes you pay, any management fees, and that silent killer, inflation. These are basically the costs of just maintaining and using your wealth.
And pulling on the other side of the rope, you have growth. This is the engine that pushes your wealth upward. It's the income you're earning from your career, the returns you get from your investments, and, any lucky financial windfalls that might come your way.
And that brings us right to the bottom line. At the end of the day, successful wealth management is about one thing, and one thing only: making sure your growth consistently overpowers your leakages. As Stuart Lucas, the author of our source material, puts it, this means keeping your spending, which is the biggest leakage you can actually control, to a sustainable level. For a financially secure retirement, that's probably not going to be more than 3.5 to 4% of your assets each year.
And so, here we are, right back at the beginning. You've seen the two paths, you've seen the different strategies, and you understand the forces that are pulling on your wealth. So the question is no longer just some abstract financial exercise, it's a real decision about your values and your vision for the future. So, are you a spender or are you a grower? Your answer is what's going to determine the entire journey ahead. The world of investing, it can feel like you're trying to navigate this dense, confusing jungle. It's just full of promises, but also a ton of hidden traps. So the big question is, how do you find a clear path through all of that? Well, today, we're going to give you a map.
I mean, think about that. This was written almost 200 years ago, and it just perfectly captures the challenge of modern investing, right?
It's not just about making money, it's about protecting what you already have in this, well, this incredibly complex and often deceptive landscape.
Honestly, this is exactly what it feels like to be a new investor. You're surrounded by all these people who sound like they know what they're doing, and they're all offering you a different path. So the real question is, who's actually on your side?
So, here's the bottom line. Yeah, there are rules and regulations, but your absolute best defense is your own knowledge. You've got to be your own advocate. In the world of investing, the one golden rule you have to remember is buyer beware.
Okay, so to really get why it's so tough for individuals to succeed, we've got to go back in time a little bit. We need to look at this massive shift that happened decades ago. Basically, this huge gap opened up between how the big institutions invest and how the rest of us do. Let's dig into how that actually happened. Believe it or not, it all comes down to one single piece of legislation from back in 1974, the Employee Retirement Income Security Act, or ERISA for short. Now, it was designed to protect company pension plans, which sounds great. But it had this massive, completely unintended consequence. It totally changed the very definition of a safe investment.
And this slide, this really shows the crucial shift in thinking. Before ERISA, the rule was simple. Every single investment had to be prudent all by itself. Think safe, high-quality stuff. But after ERISA, suddenly a portfolio could include all sorts of risky things. We're talking hedge funds, venture capital, as long as the whole basket was diversified. This one change, man, it just unleashed this tidal wave of new, super complex investment products.
So, to navigate this brand new, super complex world, the large institutions, well, they developed a massive advantage. The source material for this explainer calls it the 4 A's. First, they hired armies of researchers for acumen. That's deep expertise. They used their sheer size to get access to the absolute best deals, the ones you and I never see. They demanded alignment with their fund managers, making sure everyone's interests were in the same place. And finally, they built these incredibly sophisticated systems for accountability. They basically turned investing into a professional sport.
So, okay, this explosion of choice and complexity, it was fantastic for the big players. But what about you? What about the individual investor? Did this new world make it easier for the average person to invest successfully, or did it make it a whole lot harder?
And this chart, wow, it really tells the story in some stark numbers. Look at this. Over a 20-year period, the stock market itself returned 13%. The average mutual fund, after you pay all the fees, got 9.9%. But the average investor, a measly 6.6%. They left almost half the potential money on the table. That right there is the cost of trying to navigate this investment world without a map.
Okay, so if the landscape is this treacherous, how on earth do you find your way? Well, the analysis we're breaking down today gives us a simple but really powerful tool, a map. A map that divides the entire investment universe into 3 completely distinct worlds.
And just knowing which one of these 3 worlds you're operating in, that's the absolute key to making smart investment decisions. So, come on, let's take a quick tour.
All right, first up, we have what's called the Enchanted Forest. It's a really tempting place, right? It's full of slick marketing, big promises about beating the market. But the reality is, it's often a place where ambition just runs way ahead of actual skill. This is the world of the so-called country club gambler, where people are just trading hot tips back and forth and treating investing like it's some kind of high-stakes game. Okay, then you have world number 2, the secret society. Now, this is where the true investment geniuses live. These are the folks who can consistently generate what's called positive alpha. All that really means is they beat the market. So if the market returns 10%, they might get 12%. But here's the catch. It's a zero-sum game. For them to win, someone else has to lose. And you better believe the gates to this place are very, very well hidden. A lot of people who think they're in the society, well, they're actually just lost in the enchanted forest.
And finally, there's the third world, the capital kibbutz. Now, if you don't know, a kibbutz is a type of community where everyone shares in the rewards together. And in this investment world, you're not trying to beat the market, you're trying to be the market. This is the world of simple, low-cost, passive investing. Think index funds.
So there we have it, our map with 3 very, very different destinations. And now for the big question, which one of these is right for you?
This table really just lays it all out nice and simple. The Enchanted Forest, you're looking at high fees and, most likely, underperformance. The Secret Society, that's for a tiny, tiny elite. So that leaves the Capital Kibbutz, which simply gives you the market's return at a super low cost. When you see it like this, for most people, the choice becomes pretty clear, doesn't it?
So when you really look at it this way, for almost everyone out there who can't build that massive institutional advantage with those 4 A's we talked about, well, the path forward becomes incredibly, incredibly clear.
And hey, you don't have to take my word for it. Just listen to Warren Buffett. I mean, arguably the most successful investor of all time. This guy is a card-carrying member of the secret society, and what's he telling everyone else to do? He's telling them to head straight for the kibbutz. He says it flat out. For most people, the best way to own stocks is through a simple, low-cost index fund.
So why is the kibbutz the winning choice for most of us? Well, for one, indexing is way more tax efficient. The fees are incredibly low. And get this, you get access to the exact same products as the big institutions. You get your predictable, fair share of the market's growth, and you do it without all the stressful guesswork and those killer high costs. So you see, this isn't just some abstract theory. This is a practical, usable map for your financial life. And now that you have it, your journey as a smarter, more successful investor can start, like, right now.
And that whole journey, it just starts with one simple question. I want you to look at your investments, look at your advisor, look at the fees you're paying, and just ask yourself, which of these three worlds have I been living in? Answering that one question, honestly, could completely change your financial future.
Okay, let's just jump right in with a quote that honestly hits the nail on the head. Once you have made yourself rich, for gosh sakes, don't lose it. It's one thing to build wealth, but it's a whole other challenge to actually keep it.
And that's exactly why picking your investment strategy is so critical. I mean, we're talking about the single most important financial decision you are ever going to make. This is the bedrock, the foundation for everything that comes next.
So in this explainer, we're going to walk through three very different ways to manage your money. Think of them as three distinct paths leading up the same mountain. Each one has its own terrain, its own risks, and its own rewards. So here's our game plan. First, we'll talk about why this is such a big deal. Then we'll explore each path: index investing, barbell investing, and active alpha. And finally, we'll wrap up by talking about how you can figure out which path is the right one for you. So what are these three paths? Well, the right one for you really boils down to a few things, like your goals for growth, how much time you're actually willing to put in, and of course, your current net worth. Let's dig in. And here they are in a nutshell: index investing, barbell investing, and active alpha investing. Three totally different philosophies for managing and growing your wealth. So let's get started with path number one. We're going to call our first path the steady highway. This is index investing. And if you're looking for simplicity, reliability, and just plain old proven results over the long haul, this is it. So what does that actually mean? Well, instead of trying to find that one needle in the haystack, that one superstar stock, you're just buying the entire haystack. You invest in the whole market, like the S&P 500. You're basically betting on the whole forest, not just a single tree. And you know what? The results kind of speak for themselves. This super simple, hands-off approach has historically delivered a pretty solid 6 to 8% return every year over the long run, as long as you keep your costs low. That is a seriously powerful return for a strategy that's so easy to set up. And maybe the best part is that it's a 4-step process you can pretty much set and forget. You figure out your asset mix, you pick your index funds, you manage for taxes, and you rebalance every so often. After that, it's pretty much on autopilot. Just to give you a feel for it, here's what a sample portfolio could look like. You can see it's a nice, healthy mix. Some US stocks, some international stocks, bonds, a little bit of real estate. The whole point is diversification. You want different kinds of assets that are going to react differently to whatever the economy throws at them. Okay, so that's the autopilot approach. But what if you want to be a little more hands-on? Not necessarily with picking stocks, but with your own career growth? Well, that brings us to path number 2, barbell investing. Let's call this one the balanced act. So who is this for? This strategy is really designed for professionals, people who aren't full-time investors but want to use their own skills, the stuff they already know and do for a living, as the main engine to build their wealth. And this visual just explains it perfectly. On one side of the barbell, you've got about 80% of your assets in a super safe, diversified portfolio, kind of like those index funds we just talked about. That takes up maybe 10% of your time. But on the other side, that's where you put 90% of your time and energy into your high-growth asset, your career or your business. That could mean anything, right?
starting a side hustle, going back to school for an advanced degree, or just working to become an indispensable partner at your firm.
So the barbell strategy is all about betting big on yourself. But what if you've got the resources and the desire to bet on finding the world's best money managers to do all the work for you? Well, that leads us to the most difficult path of all, what we're going to call the Everest climb, active alpha investing. Now, the goal here isn't just to match what the market does. The goal is to consistently generate alpha, which is really just a fancy way of saying returns that are above the market average. But here's the catch. Getting that tiny little edge takes a ton of effort, deep expertise, and access to really complex stuff like private equity and hedge funds. And this, right here, is the absolute central question for anyone even thinking about this path. Because you're not picking investments anymore. You're picking the people who pick the investments. So can you consistently pick a winner? The data on this is, well, it's pretty sobering. Have a look at this. These are fund managers who were in the top 25% over a 5-year period. Where did they end up in the next 3 years? Almost 40% of them fell all the way to the bottom 25%. It's just a massive reminder that past performance really doesn't guarantee future results. And that climb just gets steeper. You need specialized knowledge. The fees are astronomical. We're talking a 2% management fee plus 20 or 30% of any profits. And, even if you manage to find that one amazing manager, chances are their fund is closed to new investors anyway. It is a very, very tough game to play. All right, so we've walked through the 3 paths, the steady highway, the balanced act, and the Everest climb. Now let's put it all together so you can start thinking about your own destination. This is where you get to decide which journey is the right fit for you. This table just lays it all out so clearly. Index investing, that's for most people. It's low effort, you get reliable market returns. Barbell investing is for professionals who are ready to bet on their careers. It's a high-effort play, but it has what we call asymmetric upside, huge potential gains on your career side while your investment stays safe. And then there's active alpha. That's for the full-time experts. It's an incredibly high-effort, high-risk path for what might only be a small outperformance. So at the end of the day, which path is right for you? There isn't one right answer. It all comes down to your goals, your skills, and, frankly, how much time you're willing to commit. We've shown you the map. Now it's up to you to choose your path.
When we talk about making your most important hire, we're not talking about finding a new executive for your company. Nope. We're talking about recruiting the most critical member of your personal financial team. And let me tell you, if you get this wrong, it can cost you dearly. But if you get it right, it can secure your entire future.
Okay, let's just dive right into this with a really powerful idea from Howard Schultz. Hiring isn't about finding a clone of yourself, right? It's a strategic move to fill your gaps. It's about bringing in expertise where you might be lacking. This, right here, is the exact mindset you need when you're building your wealth management team.
So let's frame this in a way that just makes perfect sense. I want you to think of yourself as the CEO of your own wealth. You're the wealth strategist. You set the vision, you define the goals. But come on, every great CEO needs a chief operating officer to actually execute that vision. So the big question is, who's running the day-to-day operations of your wealth?
So let's start with your most important hire.
The source material we're looking at calls this person a financial administrator, or FA for short. And what's really interesting here is the framing. They are a partner. Their job is to execute your strategy. They work for you, making your financial plan a reality. That's a huge distinction.
Let's move on and see how this builds. A great way to think of them is as your financial co-pilot.
So on a really practical level, what does this person do? Well, their main job is to be the central hub. They coordinate everything. They work with you, obviously, managing your cash flow and records. They talk to your other advisors, your lawyers, your accountants, to make sure everybody is on the same page. And they oversee the totality of your assets, keeping an eye on performance and risk.
And this really breaks down into 3 core skills. First, they have to measure everything. We're talking tracking performance and plugging any financial leaks like unnecessary fees or taxes. Second, they organize all your records, keeping everything secure and up to date. And third, and this is so crucial, they coordinate your specialists. They break down those silos so your lawyer and your accountant are actually working together for you.
Okay, now for part 3, searching for your FA.
So the crucial thing to remember is you're looking for these key traits: conscientious, strong character, high integrity. I mean, those are non-negotiables, right? But I want you to look at the last 2 points on this slide, because they are everything. They must be accountable to you, and their interests have to be perfectly aligned with yours. This isn't just a hire, it's a relationship built on trust, where your success is literally their success.
Now here's a huge piece of advice from the source material. Avoid the super common mistake of hiring a bunch of FAs and making them compete. I know it sounds smart in theory, but in reality, it's a logistical nightmare. It's almost impossible to compare performance accurately, and it just distracts from the one thing that actually matters: your overall financial health.
Okay, let's move on to Section 4, vetting the firm. Because listen, finding the right person is only half the battle. It all comes down to this one single concept: alignment of interests. This is the master key right here. Aligned interests mean the firm makes more money only when your assets grow. A conflict of interest means they have hidden incentives to sell you products whether they're good for you or not. It's the difference between a real partnership and just being part of a sales pitch.
And to see just how high the stakes are, let's look at a quick cautionary tale from the source material. This is exactly what happens when those interests are not aligned.
So the story is about an advisor the author calls Martha. She convinces a client to buy these high-fee variable annuities. And here's the kicker, the massive red flag. She put them inside the client's tax-deferred pension plans, where the main benefit of an annuity, that tax deferral, is completely and totally useless.
And this just brilliantly illustrates the danger. The client ended up paying nearly 4% a year in fees, which just destroyed any potential gains. Martha, on the other hand, walked away with a massive commission. The client lost, the advisor won. That, my friends, is the absolute definition of a conflict of interest.
So that whole Martha story forces you to ask the single most important question you can ask: how does my advisor get paid? This chart shows the main models. The source material strongly prefers the asset-based model, because your interests are aligned. If your assets grow, their fee grows. It's that simple. Transaction-based models, on the other hand, well, they can incentivize frequent and maybe unnecessary trading.
And you have to be a detective about hidden fees. I'm serious. Things like 12b1 marketing fees, brokerage fees, or steep penalties if you want to switch investments. Don't be shy about this. You have every single right to ask for a full, written disclosure of every single way the firm makes money from your account.
And finally, that brings us to Section 5, managing the partnership.
Because once you've hired them, the work isn't over. The single best tool you have for managing this relationship is the annual review. And let's be crystal clear, this is not a sales meeting for new products. It is a comprehensive, top-to-bottom review of your entire plan, your performance, and your goals. And this, right here, is your checklist. You need to ask the tough questions. Is our performance on track? How are changes at your firm impacting me? Has my risk profile changed? What about my estate plan now that things in my life have changed? This checklist turns you from just a passive client into an active, engaged CEO of your own wealth. So we'll end with this. After all this, the real question becomes, is your financial team truly built for success with a trusted co-pilot at the center? Or are you still trying to fly this incredibly complex machine all by yourself? The answer, well, it could change everything.
All right, let's just jump right in. We're going to talk about something most of us, absolutely dread: taxes. But what if I told you that the thing you dread most could actually be one of your best allies in building wealth? Yeah, I know it sounds totally backwards, but stick with me. Today, we're going to break down exactly how the wealthy flip the script on taxes and how you can too. First things first, you have to understand just how big of a deal this is. This quote really puts it into perspective. For the wealthiest people out there, taxes aren't just an annoyance. They are one of their absolute biggest expenses, year in and year out. Now, if it's that huge for them, just imagine the bite it's taking out of the rest of us. It's a massive hurdle we all face.
So that brings us to the million-dollar question, right? If taxes are this giant financial drain, this massive expense, how in the world can they be your friend? How can you possibly turn them into an advantage? Well, the secret isn't in some complicated loophole. It's in a complete shift in how you think about the whole system.
So let's start with this big idea: reframing your relationship with the tax code. Stop seeing it as this big, scary book of rules designed to take your money. Instead, start thinking of the government as, well, as your silent partner.
Let me explain what that silent partner concept really means. Think about it. An investment manager, they might charge you a fee whether your portfolio goes up or down. But the government, Uncle Sam, only gets paid when you make a profit. Their success is literally tied to your success. If you don't win, they don't get a cut. Their interests, in a very real way, are aligned with yours. That's a huge mindset shift.
So if the government is your partner, how does it tell you what it wants you to do? Well, it leaves clues, big ones. And this chart tells an incredible story. Look at the top income tax rate. It's been all over the place, sometimes spiking to an insane 90%. But now look at the long-term capital gains rate. It's been so much lower and way more stable for almost a century. The message from your partner couldn't be clearer.
And that's the whole point. The tax code isn't random. It is deliberately designed to encourage certain behaviors. By keeping the tax on investment profits, capital gains, way lower than the tax on income, the system is practically screaming at you to be a patient, long-term investor.
Which brings us to this next idea, and it's a powerful one, the power of benign neglect. This is where the real magic of tax-efficient investing happens. It's the radical idea that sometimes the smartest thing you can do with your money is absolutely nothing.
This quote just nails it. It's such a simple concept, but it's so hard for us to do. We live in a world that tells us to constantly be doing something, trading, tweaking, rebalancing. But the discipline to just let your investment sit and grow can be your single greatest advantage. Let's look at the math that proves it.
So here's the secret sauce. When your stock or your investment goes up in value, you technically owe tax on that growth. But, and this is a huge but, you don't have to pay it until you sell. So that unpaid tax bill, it's basically an interest-free loan from the government. You get to keep that money working for you, compounding year after year. And you, and only you, get to decide when to repay that loan by finally selling.
And believe me, this isn't just theory. The source gives this amazing real-world example. One family held on to their stock in the Carnation Company for 86 years. 86 years! For generations, that money was just compounding, with that interest-free loan from the government getting bigger and bigger, fueling even more growth, until the company was finally acquired.
Okay, let's get into the hard numbers. This is where it gets really interesting. We've got 5 different investors here. Notice, they all start with the same 100 grand. They all get the exact same 900% return before taxes. The only thing that's different is what they do. Up top, you've got the patient investor who just holds on for dear life. And as you go down the list, they get more and more antsy, selling more frequently until you hit the hyperactive trader at the bottom. Now just look at what happens to their final take-home amount in that last column.
And if the table didn't make your jaw drop, this chart will. It's the same story, but you can see it plain as day. The patient investor, the one who practiced benign neglect, walks away with $865,000. The hyperactive trader, they're left with just over $490,000. Same investment, same market performance, but a totally different outcome. All because of taxes and trading. It's just staggering.
Just let that number sink in. Over $374,000. That is the price of impatience. And what's so important to get is that it's not just the money they paid in taxes. No, it's the lost opportunity cost. It's all the growth that money could have generated if it hadn't been sent to the IRS year after year. It was no longer working for them.
So, okay, if holding on is so powerful, the obvious next question is, can I, avoid paying capital gains tax forever? And believe it or not, the answer, in some cases, is yes. Let's walk through 4 completely legal strategies for doing just that.
All right, let's break these down. First up, the simplest one. Just don't sell. Hold your assets for your entire life and pass them on to your heirs. Second, you can use something called tax-managed funds. The managers of these funds are smart. They intentionally sell some investments at a loss to cancel out the taxable gains on their winners. Third, a real win-win. Donate appreciated stock directly to a charity. You avoid the tax on the gain and you get a nice tax deduction. And fourth, this is a big one, something called the stepped-up basis. Basically, when you die and pass an asset to an heir, the IRS can reset the cost basis to what it's worth now, which can completely wipe out the capital gain for that.
Okay, now for a curveball. We've been talking about how great tax deferral is, right? But here's where our source throws in a really important warning. Be careful about putting all your eggs in the traditional tax-deferred basket, like a 401k or an IRA.
This table really shows you why. In a normal taxable account, you invest money you've already paid tax on. But when you take it out, you pay those nice, low, long-term capital gains rates. Now look at the 401k. You get a tax break today, which feels great. But when you pull that money out in retirement, every single penny is taxed as regular income, which is almost always a much, much higher tax rate. And here's the bottom line, straight from the source. Is it actually possible to be worse off for using a retirement plan? The short answer is a surprising yes, especially if income tax rates go up between now and when you retire. You've essentially just kicked the can down the road, trading a low tax rate for what could be a much higher one later on. So let's tie this all together with the big takeaways. Number 1, change your mindset. Taxes aren't a battle, they're a partnership. Number 2, learn to love benign neglect. Patience and long-term holding are your superpowers. 3, be proactive about managing for tax efficiency. 4, know the pros and cons of every tool you use, even something as common as a 401k. And last, but definitely not least, remember that your patience is the most powerful wealth-building tool you will ever have. And that really leaves us with one final, very important question you have to ask yourself. Now that you know how the system is designed to work, now that you see the incentives, take a hard look at your own finances. Are you actively managing your taxes to your advantage, or have you been letting them silently manage you?
So today we're diving into a really powerful concept for any family that wants to build a legacy that actually lasts. It's called entrepreneurial stewardship, and it's basically a playbook for making sure a family's values and, their wealth stick around for the long haul. Let's get into it. This quote from E.A. Stewart, who started the Carnation family fortune, just perfectly captures the spirit of what we're talking about today. See, it's not just about the money, right? It's about keeping the door of opportunity open for the next generation, and the one after that. It's a true multi-generational mindset. But man, is that vision hard to pull off.
You've probably heard the saying, shirt sleeves to shirt sleeves in 3 generations. It's a classic for a reason. You know the story. The first generation builds it all, the second one kind of holds on, and by the third, poof, it's gone. But why? Why does this happen over and over again? Well, the answer has to do with moving beyond just trying to preserve wealth and into something way more active.
Okay, so here's our game plan. We're going to tackle this in 5 parts. First, we'll look at the generational wealth puzzle itself. Then, we'll break down the 5 crucial roles of a true steward. After that, we'll talk about why it's so important to find your own success, the big challenge of raising capable kids, and finally, how to think of your family like a business.
All right, let's jump into the core problem. How in the world do you make wealth last? The idea we're exploring today suggests a solution that's about so much more than just hoarding cash. It's a dynamic, hands-on approach called entrepreneurial stewardship.
So this is really the key. It's not about just sticking your money somewhere safe and hoping for the best. Nope, it's an active process. You have to balance being careful like a preserver with having the vision of an entrepreneur and the guidance of a real leader. If you don't have that balance, the wealth just, well, it's not going to survive.
I love this metaphor. Think about your family's wealth like it's an economic engine. For that engine to keep running, it has to generate enough power, in this case growth, to overcome all these constant financial leaks. You've got taxes, inflation, family spending, they're always dripping away. Just putting the car in neutral isn't enough. You've got to be actively hitting the gas and growing.
Okay, so if entrepreneurial stewardship is the engine, what are the actual parts that make it go? Well, our source material breaks it down into 5 different roles, or hats really, that a person has to wear to be a true steward of their family's legacy. Let's take a look. And here they are, the whole journey laid out. It starts with being a beneficiary. Then you evolve into a steward and an entrepreneur. You find a deeper purpose as a philanthropist, and you bring it all full circle by becoming a mentor. Let's quickly touch on each one. So, role number 1, the beneficiary. This is all about your starting point. It begins with just acknowledging that you are standing on the shoulders of the people who came before you. It's about having gratitude for the head start you've been given. Honestly, that's the essential first step. Now, once you have that gratitude, you can step into the role of the steward. This is that classic duty of care, right? The responsibility to protect what you've received. The huge mindset shift here is realizing you're not just managing it for you, you're managing it for generations you may never even meet.
But like we said with that economic engine, just protecting isn't enough. And that's where the entrepreneur role comes in. This is all about taking smart, measured risks to actively grow the family's capital. You have to keep that engine running strong enough to plug all those leaks. The 4th role, the philanthropist, is where the wealth gets a much deeper meaning.
By using your resources to give back and help others, you connect your family's legacy to a purpose that's way bigger than just its own survival.
And finally, we have the mentor. This is where you close the loop and make sure the whole cycle can start over again. It's about intentionally teaching the next generation, passing on not just the assets, but the wisdom, the values, and the skills they're going to need to start their own journey.
Now, here's something that's absolutely crucial to becoming a great steward. You have to build your own identity. You have to find success on your own terms, completely separate from the family name. You really can't lead if you haven't proven yourself.
This quote from the author just nails it. For a lot of people who grow up with privilege, there's this nagging question: did I earn this? There's this deep need to know that your achievements are yours, not just handed to you. And that drive for validation can be an incredibly powerful thing.
And you can see that journey right here. By deliberately choosing a different path from his dad, he made sure that his wins and his losses were his and his alone. You know, the source actually argues that it's often a huge mistake for kids to go straight into the family business. It can completely snuff out that entrepreneurial spark before it even gets a chance to light up.
So this leads us to maybe one of the biggest challenges of all. How do you raise kids to be driven, responsible, and capable when they're growing up surrounded by privilege? Well, the source offers some really profound, universal advice on this. It's about focusing on their passions, not pushing your own agenda. Remembering that your time, your presence, is worth way more than any gift. Letting them make small financial mistakes when they're young, so they learn that money isn't infinite. And really prioritizing simple things, like dinner together, to stay connected. It's all about empowering them, not just enabling them.
But, let's get real for a second. Not every kid is going to be a natural-born financial genius. The source is very clear that entrepreneurial talent can sometimes skip a generation, and that's okay. The key is to be flexible and patient. Sometimes that means bringing in trusted advisors from the outside to help bridge the gap until the next generation is truly ready to take the reins. Okay, for our last section, let's zoom out. We've talked about the individual, but to really make this work, the entire family has to learn to operate like a well-run, cohesive team, like an enterprise.
So, to manage all their moving parts, many wealthy families set up what's called a family office. But, and this is a big but, there's a world of difference between a family office that just passively manages the money and one that actively works to grow it for the future. And here is that key distinction. Most people think of a family office as, an admin hub. It does taxes, bookkeeping, maybe some concierge stuff. But the author's view? No way. It should be the family's economic engine. Its main goal shouldn't be to make life cushy and create dependency. It should be to drive growth and push every single family member towards self-sufficiency. This brings us to a really tough conversation around fairness. Is it fair to treat every kid exactly the same? The source argues pretty strongly that no, it isn't. Treating everyone equally can lead to this thing called economic outpatient care, where you're constantly bailing people out, which just creates dependency. True fairness, it says, is about treating each person differently, giving them the specific support they need to stand on their own 2 feet.
And all of this brings us to one final thought. Entrepreneurial stewardship, when you boil it all down, is about way more than just managing stocks and bonds. It's about growing talent, teaching values, and building a family culture of purpose and responsibility. So the ultimate question really isn't about the money. It's about the legacy. Beyond all the dollars and cents, what is the true inheritance you want to leave behind?
So let's talk about legacy. What does it actually mean to leave one? Today, we're going way beyond just the idea of writing a check. We're going to dive deep into strategic philanthropy, which is really the art of making your giving just as smart, just as impactful as your earning. Let's get right into it.
To really get why this conversation is so urgent right now, we have to wrap our heads around a number that is just massive. Trillions. Over the next half-century or so, a truly historic amount of wealth is going to change hands. Now, this isn't just about kids inheriting money. This is a once-in-a-generation chance to reshape our world. And it forces every single one of us to ask a really important question.
And that's the bottom line, isn't it? After all the years of work, all the building, what story is your wealth going to tell when you're gone? For a lot of people, the most powerful answer to that question is found in how they decide to give back.
And hey, this is not some new idea. Just think about E.A. Stewart, the guy who founded Carnation. Picture this, it's 1937, the absolute height of the Great Depression. Most people are just focused on surviving.
And that's when he decides to formalize his giving, creating a foundation. This wasn't some kind of PR stunt, it was him solidifying his life's work of supporting the very communities that allowed him to succeed in the first place.
And this quote, wow, it just perfectly captures his motivation. You see, it was never about just giving handouts for him. It was about investing in opportunity itself. He wanted to make sure that the ladder he was able to climb was still there, strong and steady, for the next person with a dream. That right there, that is the soul of strategic philanthropy.
Okay, so here's our game plan for today. We're going to start with the why, the real motivations behind giving. Then we'll get into the how with a practical playbook. We'll also cover some really smart financial strategies, and we'll wrap it all up by talking about the powerful link between philanthropy and family.
First up, why we give. Before we get into any of the numbers or the structures, let's ask a much more human question. What actually drives someone to give away the wealth they worked so hard to build?
Well, it turns out that most of the reasons fall into one of these 6 categories. You've got everything from the purely altruistic, wanting to make a huge, profound impact, to a deep sense of responsibility. But there's also things like building social capital, being inspired by what others have done, feelings of guilt, and of course, the very practical motivation of tax relief.
John D. Rockefeller really said it best. This core belief that with great fortune comes great responsibility is a massive driver for so many philanthropists. It's this idea that wealth isn't just something you own, it's something you have a duty to do something with.
And if you want to see what profound impact looks like in the real world, just look at Joan Kroc. Her incredible gift to NPR, we're talking nearly $200 million, wasn't just a donation. It was a complete game changer. With that one act of generosity, she basically guaranteed the future of a vital public service for generations. Now that is a legacy.
All right, so let's say you've figured out your why. Now it's time for the how. So let's open up the playbook and look at the main ways you can actually structure your giving. There are basically 4 main roads you can go down, and each one has its own set of rules.
Think of it as a spectrum, going from the simplest to the most complex. You start with direct donations, literally just writing a check. Then you have support organizations like community foundations. A step up from that are donor-advised funds. And finally, the most hands-on approach is creating your very own private foundation.
And here's what's so fascinating. It's all about the trade-offs. Just look at this chart. As you go down the list, from a direct donation to a private foundation, notice what happens. Your level of control goes way up, right? But so does the complexity. A private foundation gives you the absolute final say on everything. But it's a huge undertaking, and forget about being anonymous. It's just not possible.
Okay, so we've got the structures down. Now let's talk strategy. This is where we shift from just giving money away to giving smarter. It's about making every single dollar you donate work as hard as it possibly can and really weaving philanthropy into your overall financial plan.
All right, listen up because this is a big one. It is almost always better to donate appreciated assets like stocks instead of cash. And here is exactly why. Look at the 2 scenarios. In both cases, the charity gets $10 and you get a $10 tax deduction. Great. But, and this is the absolute key, when you donate the stock directly, you completely avoid ever paying the capital gains tax on its growth. It's like you're making an extra donation to your cause, totally free, thanks to the tax code. It's a huge win-win.
And this whole smarter mindset is leading to some really cool, innovative new approaches, like venture philanthropy. The best way to think about it is applying a venture capital, startup-style approach to solving social issues. So you're not just funding a soup kitchen, you're investing in a new, scalable model that could potentially end hunger across an entire city. It's all about funding disruption for social good.
Which brings us to our final piece of the puzzle. And honestly, this might be the most important part of all, because when you strip away all the tax codes and financial strategies, philanthropy is deeply, deeply personal. It's about family. Let me tell you about the Lehman family. After they sold their company, the thing that had held them together for generations was gone. They could have easily just drifted apart, but instead, they created a new shared mission. They started a nonprofit that used all their business smarts for good. And that new purpose, it became the glue that bound 4 generations of their family together. So if your family is kicking around the idea of starting a foundation, you have to ask some really tough, honest questions. Do you have a mission that is crystal clear? Do you have the financial scale to actually justify all the costs and complexities? Is having that high level of control a top priority? A foundation can be an incredibly powerful tool, for sure, but it's definitely not the right answer for everyone.
And we want to leave you with this final thought, which is really inspired by E.A. Stewart's story. It's a direct challenge to the way we usually think about wealth. Maybe, just maybe, true wealth isn't measured by what you manage to keep, but by what you choose to contribute. So, the question for all of us is, what will our legacy be?
Welcome to The Explainer. You know, when we think about estate planning, our minds usually jump to lawyers and paperwork, right? But what if it wasn't about that at all? What if it was about writing the next chapter of your family's story? Today, we're going to dig into a 6-step roadmap that helps you build a legacy. One that's not just about passing on money, but about passing on opportunity. This quote from John Adams, wow, it just nails it, doesn't it? This is the whole point. It's not about just leaving your kids a pile of cash. Nope. It's about building a foundation so strong, so secure, that they have the freedom to chase their dreams, to become artists or entrepreneurs or whatever they're passionate about. It's a luxury for sure, but one that's built on the hard work of the generations that came before. Yeah, most of us see estate planning as this huge, intimidating mountain of paperwork. And who wants to deal with that? But let's try a little thought experiment. What if we just reframed it? What if we started seeing it as the ultimate act of storytelling, writing a story that keeps going long after we're gone? So let's dive in and figure out how you can become the author of your family's future. Okay, so here's our game plan for today. We're going to start with the big picture vision, then I'll walk you through a clear 6-step roadmap. After that, we'll get into the nitty-gritty, building the foundation, managing family assets, the legal toolkit you'll need, and we'll wrap up with what your ultimate legacy is all about. All right, let's get to the heart of it. The core of this whole approach is a really simple, super flexible 6-step roadmap. The beauty of it is that it takes this massive, overwhelming task and breaks it down into bite-sized pieces. It lets you build a complete, solid plan, one step at a time. And here it is, the whole journey laid out for you. You can see how it flows, right? We start with communication and defense. Then we move into managing those different kinds of assets, and we finish up with the absolute legal must-dos. The big takeaway here is that you build this thing layer by layer. So let's get started with that crucial foundation, steps 1 and 2. Now this might sound a little backwards at first, but trust me, the very first step in planning for your kids' future is actually planning for your own. Seriously, making sure you're financially solid in your own retirement is maybe the greatest gift you can ever give them. Why? Because it frees them from ever having to worry about supporting you. So step 1 is all about communication. It's just talking, having these conversations early and openly about the things you see here. It takes all the guesswork and, frankly, the stigma out of it. It can prevent some really painful arguments down the road about healthcare or what to do with the family home, especially at a time when everyone's already going to be at their most vulnerable. And this right here, this is probably the single most important mindset shift you can make in this entire process. We always ask, how much should I give them? But that's the wrong question. The real question is, how should I give it to them? See, the goal isn't just to dump a pile of money in their lap. That can actually do more harm than good sometimes. The real goal is to transfer that wealth in a way that empowers them, that helps them lead productive, fulfilling lives on their own terms. So how do you actually do that? How do you empower them? Well, one really powerful tool is something called the annual gift tax exclusion. Now, based on the source material, a couple could give up to $22,000 to any single person every single year completely tax-free. Just think about that. It's a simple, straightforward way to start building your kids' financial independence 1 year at a time. Okay, but what does that really add up to? The power of that one simple act, it is absolutely staggering. I mean, look at this example from the source material. If you take those annual gifts and just invest them in a simple index fund over, say, 50 years, they could grow to over $25 million. This isn't about making your kids dependent, not at all. It's about giving them such a secure retirement foundation that they have the freedom to take smart risks and build amazing careers of their own. All right, so we've built our defensive foundation. That's huge. Now let's start talking about the assets themselves. And this is really important. You have to understand that not all assets are created equal. They basically fall into 2 very different buckets, the ones you manage with your heart and the ones you manage with your head. On one side, you've got what we call legacy assets. Think of the family vacation home or an art collection. These are driven by emotion, by sentiment. They can be wonderful, but man, they can also cause a lot of conflict. Then, on the other side, you have the economic engines, things like a family business that's actually making money. These are driven by finance.
The key, and this is so critical, is that you have to manage these two things completely differently. It's stewardship for one, and it's growth for the other. Now, for a family business, the source material points to this really clever strategy called an estate freeze. Here's how it works in a nutshell. The older generation essentially sells the business to the younger generation, but at today's value. The parents get steady payments over time, kind of like a retirement plan, while the kids get to keep all the future growth that they create. It's a total win-win. It passes the torch and secures everyone's financial future at the same time. Okay, let's recap. We've got our foundation secured. We've got our asset strategy in place. Now, we need to talk about the legal toolkit, the actual structures that bring this whole plan to life, and, more importantly, protect it for the long haul. And one of the most powerful tools in that toolkit is the irrevocable trust. The easiest way to think about it is like a financial fortress you build around your family's assets. Once you put things inside and you set the rules, that's it. The terms can't be changed, and that's its superpower. It shields that wealth from creditors, from lawsuits, even from messy divorce proceedings. It basically ensures the wealth stays in the family for generations to come. And that brings us to the absolute non-negotiable must-dos. The source material lays out 5 things you just gotta do. Let's run through them real quick. You need a will. That's to state your wishes and name guardians. You need a revocable trust to keep your assets out of the public eye of probate court. A marital trust is key for providing for a spouse while making sure you control where the assets go in the end. Giving assets to your spouse during your lifetime can be a smart tax move. And finally, those irrevocable trusts for your kids, they're there to protect their inheritance if the unexpected happens. These 5 things, they are the absolute bedrock of a solid plan. So, after all of this, all the planning, all the strategies, all the legal stuff, what's it really all about? I mean, at the end of the day, it's not just about dollars and cents, is it? It really boils down to 3 core ideas, 3 principles that define what your true legacy will be. And here they are, the 3 pillars of a real legacy. First, it's about security. Think of it as a financial shield that protects your family's most important needs: education, health, retirement. Second, it's about family. You want to proactively plan to keep everyone together, to maintain harmony, not create division. And third, it's about empowerment. It's about transferring wealth in a way that actually motivates your kids and creates new opportunities for them. If you can get these 3 things right, you've built something that will stand the test of time. Because ultimately, this whole process, it's not really about looking back at everything you've accumulated, is it? It's about looking forward. It's about asking yourself this one very powerful question. The real goal here is to prepare the people who come after you, to help them accept the responsibility of wealth, and to give them the foundation to live rich, useful, and truly productive lives. Thanks so much for joining us for this explainer.